What if I told you the greatest investor alive doesn't rely on secret formulas or Wall Street wizardry? Warren Buffett beats the market using these surprisingly simple strategies. The buffet table of investing. Imagine walking into the world's biggest buffet. You could pile your plate with everything in sight. But Warren Buffett doesn't do that. He picks a few dishes he really loves and sticks with them. That's his investing style. Instead of chasing every hot stock, he chooses businesses with staying power, kind of like how pizza will always be a crowd favorite no matter what. Buffett believes success comes from focus, patience, and knowing what's truly worth your money. Think of it like grocery shopping. If you only buy things you understand and will actually use, you waste less and save more. That's Buffett's mindset in a nutshell. Keep it simple, stick to what makes sense, and don't let the noise of Wall Street turn your shopping trip into chaos. Building moats like castles. Picture your favorite theme park. Why do people keep going back even though tickets aren't cheap? Because no one else delivers the same magical experience. That's what Buffett calls a moat, like the deep trench protecting a castle. A moat is a company's defense against competition, whether it's brand loyalty, super low costs, or a product everyone feels stuck with. Think about Coca-Cola. You don't drink it because it's the only soda, you drink it because it feels familiar, like a safe choice at every cookout. That emotional connection is their moat. Buffett hunts for companies that can defend their territory for decades, not just until the next fad comes along. He wants businesses that make it really hard for rivals to storm the castle, because in investing, protecting your ground is just as important as gaining new ground. Managers who steer the ship. Visualize getting on a cruise ship. You're not inspecting the engine room or steering from the captain's chair. You trust the crew to know what they're doing. Buffett thinks the same way about company managers. A business can have the best product in the world, but if leadership is careless or dishonest, it's like letting a reckless driver borrow your car. He looks for leaders who are not just smart, but also honest and disciplined with money. Buffett loves managers who act like responsible guardians, not gamblers chasing short-term wins. If the captain can steer through storms and keep passengers calm, the journey stays smooth. So when he invests, he's really betting on people as much as numbers. And his rule of thumb is simple. Don't board a ship if you don't trust the captain. Staying in your lane. Think about driving through a neighborhood you know well. You're confident at every turn because you've memorized the streets. Now, imagine being dropped in a foreign city with no map. You'd probably get lost fast. That's exactly why Buffett invests only in areas he understands, what he calls his circle of competence. He studies businesses he can actually explain, like soda, railroads, or insurance, instead of chasing the latest buzz in biotech or crypto. If you don't know how a company really makes money, investing in it is like driving blindfolded. Sure, you might make it a few blocks, but odds are you'll crash. Buffett believes knowing your lane keeps you from reckless detours. By sticking with what he deeply understands, he can judge risks clearly and avoid the flashy distractions that trip up other investors. Why Buffett doesn't pile his plate. Fancy being at a cookout with 20 different desserts. Most people try to grab a little of everything, but Buffett would rather take a big slice of the 3 pies he actually loves. That's his take on diversification. For beginners, spreading money across many companies makes sense, kind of like sampling at a buffet, so one bad dish doesn't ruin your meal. But Buffett says too much diversification waters down the flavor. He'd rather concentrate on a few companies he understands deeply, like Coca-Cola or Apple. To him, owning too many stocks is like having cruise control in every car you drive. Safe, sure, but not exciting. By focusing his bets, He enjoys the richest flavors without filling his plate with bland extras. In his world, quality always trumps quantity. Following the business recipe. Ever tried making a dish without knowing the recipe? You end up guessing how much salt or sugar to add, and it rarely tastes right. Buffett says investing works the same way. Before putting money into a company, he studies the business model like it's grandma's famous recipe. What are they selling? Who's buying? Why do customers keep coming back? If the answers aren't simple and clear, he passes. Buffett avoids businesses so complex that they feel like a chemistry experiment. Instead, he sticks to companies that run like a reliable slow cooker. Steady, predictable, and easy to understand. If you can't explain how a business makes money in one sentence, chances are you shouldn't invest in it. Simplicity isn't boring in Buffett's playbook. It's the secret ingredient that keeps the recipe consistent. Knowing when to pack up and leave. Suppose you're watching your favorite television show. At first, the story is gripping, but then the writers run out of ideas, and it starts dragging. Do you stick it out forever just because you love the first seasons? Buffett says investing is no different. He doesn't sell stocks just because they rise or fall in price. He sells when the story changes. Maybe the company loses its edge, leadership starts fumbling, or its products no longer matter. That's when he considers walking away. He also sells if he finds a much better opportunity, kind of like switching channels when another show catches your attention. His point is simple. Don't cling to something just for nostalgia. If the quality disappears, it's okay to leave. Great investments last, but only as long as their story stays strong. The cushion of safety. Think of jumping on a trampoline. You're not counting on perfect landings every time, because the springs give you some wiggle room. Buffett calls this the margin of safety. When he invests, he looks for companies priced lower than what they're really worth. That way, even if he misjudges a little, the cushion softens the fall. It's like buying a house below market value. Even if the neighborhood doesn't boom, you still have equity built in. Buffett says the margin of safety is one of the most important ideas in investing because it protects you from being completely wrong. Without it, you're basically jumping on bare concrete and hoping not to slip. The cushion doesn't eliminate risk, but it makes mistakes far less painful. That's how he stacks the odds in his favor. Keeping dry powder ready. Imagine your favorite store announcing a once-in-a-decade clearance sale, but you've already spent every dollar you had. Painful, right? That's why Buffett always keeps some cash handy. Having cash isn't about earning interest, it's about flexibility. When the market dips and everyone else is panicking, he can step in with cash ready to scoop up bargains. It's like carrying an umbrella even on sunny days. You don't need it often, but when the storm hits, you're glad it's there. Cash also keeps you from selling investments in desperation if you suddenly need money. Buffett treats cash like a safety net and a springboard rolled into one. It cushions you in tough times and launches you toward opportunities when others are stuck. In short, having cash on hand is financial peace of mind. The danger of playing with borrowed chips. Picture sitting at a poker table with borrowed chips. If you win, great. But if you lose, you still owe money you don't have. That's leverage. And Buffett avoids it like a rigged carnival game. Sure, borrowing money to invest can make wins look bigger, but it also makes losses brutal. You could lose your investment and still be stuck paying debt. Buffett prefers to only play with his own chips, so even if things go south, the damage is limited. He believes risking money you need for things you don't need is reckless. It's like taking out a loan to buy lottery tickets. For Buffett, sleeping soundly at night matters more than doubling returns through dangerous bets. Debt may amplify gains, but it amplifies pain much faster. The taxman always rings twice. Imagine running a lemonade stand where every time you make $1, someone takes a cut before you buy new lemons. That's taxes on investing. Buffett knows taxes can quietly eat into profits if you're not careful. Short-term trades often get taxed at higher rates, while long-term investments are usually taxed less. So instead of flipping stocks like pancakes, Buffett holds on to them for years. That way, more money compounds instead of leaking away to the taxman. He also pays attention to dividends and how different types of income are taxed. It's not about dodging taxes, it's about playing smarter within the rules. Like planning your road trip to avoid toll roads, understanding taxes helps you keep more of what you earn. For Buffett, efficiency isn't just about investing, it's about what you get to keep. The magic of compounding. Remember planting a small tree as a kid? At first, it looked unimpressive, but years later, it's towering over the yard. That's compounding in action. Buffett says this is one of the greatest forces in finance. When your money earns returns and then those returns start earning more returns, growth snowballs. The catch is, you need time and patience. Buffett started investing when he was just 11 years old, which gave his money decades to grow. It's like a snowball rolling down a hill, getting bigger with every turn. Many people underestimate how powerful compounding can be because it starts slow, but over time, it becomes unstoppable. His advice is simple. Start early, stay consistent, and let compounding quietly do the heavy lifting. The real magic of wealth isn't flashy moves. It's patience multiplied.